Discounted cash flow valuations. My name is Fleming. I'm a property consultant here in Dublin, Ireland. Anyone who has seen my videos in the past will know I focus on real estate investment as well as what it's like to work in the property market here in Ireland. Some of those videos can be quite boring and they're not that interesting if you're not interested in these topics. But if you are interested in property investment, make sure you subscribe and hit that ring notification bell. I was asked to do a video on discounted cash flow valuations and I was thinking to myself, how the hell do I make this video in any way interesting? I've tried my best, so keep watching to the end and hopefully you will learn a little bit more about discounted cash flow valuations. In this video, I will try to make discounted cash flow simple. I will explain the principles and I will also go through a quick example on how you would apply discounted cash flow to a property investment. Watching to the very end and make sure you put a comment in if you actually can understand discounted cash flow valuations after you've watched this video. Let me know if it helps. So first off, answer me this question, and I would like if you'd put your answers in the comments below. Would you prefer £1 million today or 100,000 every year for the next 20 years? So the question is, would you prefer 1 million today or 100,000 every year for the next 20 years? Sometimes lotto winners are given these options. I'll give you a few more seconds to put your comments and your answers down below. Congratulations, you're all right. No matter if you've picked the £1 million today or the 100,000 every year for the next 20 years. And that is the fundamental issue with using the discounted cash flow method to value property, because your answers depend on your perceived risk to that cash flow and also what other opportunities you might have today for that €1 million right now. So let's quickly explain this. And the important thing is to remember, and it's a fundamental thing to remember within discounted cash flow, is that money in the future does not have the same value as it does today. It's like that old saying, a bird in the hand is better than two in the bush. It's effectively like saying cash in your hand now is better than a promise of cash in a year's time. The discounted cash flow method is a way to value future cash flow at its present day value. But it is important to apply a discounted rate to the future cash flow. The level of discount that you apply to that future cash flow will depend on how risky you deem that cash flow to be. And also it needs to include an element of the loss of any interest you would have gained by having the $1 million right now. Let's assume a state-backed lottery offers you £1 million today or 100,000 over the next 20 years starting next year. In order for you to determine which is the best option for you, you need to decide on a discounted rate to the cash flow over the 20 years. To determine that discounted cash flow rate that you would apply, it's depending on your own circumstances. But let's just assume that you would get 2% interest rate on a cash deposit lump sum of $1 million every year. And let's also assume that you believe inflation will run at 3%. Therefore, you might deem that the appropriate level of a rate to apply to discount would be 5%. This effectively means that you're applying a 3% risk for inflation and you're also applying a 2% for loss of earnings on your interest. Let's quickly look at the opportunity where we've been given 100,000 a year by the lotto every single year for 20 years. And we've assumed a 5% discounted rate. And we've 100,000 coming in every year for 20 years. You'll quickly see that if you discount that 100,000 by 5% every single year over the 20 years, the actual value of that in today's money seriously decreases. And what you'll find is the total value of that 100,000 every single year for 20 years in today's value is actually just 1.24 million. That's a long way off the 2 million that you thought you were getting. So that's just a quick example of how discounted cash flow works if you've applied a rate of 5%. So let's quickly assume that it's not coming from a state-backed lottery, it's coming from a private company or a private individual that has offered you 100,000 per year or promised you 100,000 a year for the next 20 years. Let's assume I decide to offer you 100,000 every year for the next 20 years. Well, there's a far greater risk of me defaulting on that payment because I'm not a state-backed lottery. I could go out of business in 20 years, or lots of different things could affect my ability to make that payment. So the risk is far greater, and it wouldn't be correct to assume a 5% discounted rate because the risk is far greater. So let's actually add another 10% to that because there's an increased risk. You'll quickly see that the actual level of value, present day value for the 100,000 drops off dramatically, and what you're left with is a present day value for that 2 million that I promised you is actually only worth about 625,000 K. So therefore, if I offered you 1 million today, or if I offered you 100,000 over the next 20 years, you're far better off taking the 1 million today because there's a greater risk of actually me not being able to pay that. So hopefully now you understand the basic principles of discounted cash flow, and that it's a method to calculate future cash flow at its present day value, allowing for risk and also loss of interest. So how do you apply that understanding to property investment? I actually hear it quite a lot from people, mainly in finance, saying the yield-based valuation is not a great way to value investment property and discounted cash flow should be used more often. I think this is because they don't quite understand the task of the valuer. The valuer's task is actually to value the market, and I'm emphasizing market value of a property. The traditional method of valuing property is generally by an all-risk yield. This is the best way to value the market value of an investment property. It does not value the investment property for one individual. It values it for the general market. As a valuer cannot account for every individual investor's attitude towards risk, tax requirements, or alternative investments they may have. All things being equal, an investor will buy an investment property if they believe the investment value exceeds the market value, and they'll sell a property if they believe the market value is exceeded by the investment value. This will differ from investor to investor, as they will have different income requirements, attitudes to risks, different tax treatments, and they will all have different future outlooks. This is effectively what makes a market. It is those differences that actually create the environment where investments are bought and sold. Discounted cash flow method is best used to assist one investor on their perceived value. It is not ideal for assessing the overall market value. The discounted cash flow valuation is a great method to assist investors in buying and selling decisions. It's also very helpful for determining between two investment opportunities. The discounted cash flow method can be used to estimate market value, generally speaking only when market principles are applied to the discounted cash flow. There are many who believe more weighting should be given to discounted cash flow valuation method. Discounted cash flow method is good at predicting long-term value. However, it has its limitations in assessing short-term changes or changes in volatility in the market or shifts in market outlook. Applying the discounted cash flow method to an investment property involves estimating the cash flow or the net rent over an assumed hold period, as well as estimating an exit value. Unlike the lotto example, where at the end of the 20 years it was just the payments finished, with property you are left with something that has an end value, and that has to be allowed for within your discounted cash flow calculation. Like before, this cash flow needs to be discounted and a discounted rate needs to be applied. The discounted rate that is applied will depend on the level of risk that is deemed appropriate for that property within that market sector. It is important to only apply risk to one element of the cash flow. You don't want double count. So you want to apply it to the discounted rate, or you want to apply it to the cash flow. You don't want to apply it to both. The level of perceived risk will depend on the investor's outlook on a particular market sector. Take, for example, an investor is looking at an office investment or looking at a retail investment. The investor may deem retail to be more risky and will apply a higher discounted rate. Unlike the lotto example, cash flow within a property is not stable over the long term. Rents will change, and therefore you have to allow for this within your cash flow calculation. You have to allow for the specifics for that property. So you'll have to allow for rent review patterns, you'll have to allow for break options, as well as lease patterns, and any void periods and rent freeze you may have to allow for within the whole period. The exit value of the property will also have to be accounted for within the discounted cash flow. You will have to allow for the physical condition of the property, as well as the age, any unexpired lease terms, and the future lettability of that property. The exit value may actually revert to site value if the property is beyond its life cycle, and you may have to allow for demolishment costs within your discounted cash flow. Estimating your cash flow is vitally important within the discounted cash flow. You have to allow for future rental growth. You also have to allow for break options, rent review patterns, any void periods you may have, as well as any taxation or acquisition and sales costs. Annual costs such as insurance and any other expenses that you can't recover from the tenant should also be included within the discounted cash flow, as well as any upgrades or refurbishment works that are expected. I'll quickly run through a very simple example to explain this right now. Okay, so quickly we're going to look at a quick example here using the discounted cash flow method to value an investment property. So we're assuming here that the investor is looking for a 5-year hold on an office investment. So they're looking to buy an office investment and hold it for 5 years. We know that the first tenant on the ground floor is paying $50,000 per annum at the minute, and we know that there's a tenant on the first and second floor that are currently paying $100,000. When we look at the property, we discover that their lease on the ground floor is expiring next year, in the middle of next year, so we'll only account for rent up till the end or till the middle of next year, and we'll allow for a void period in 2022 because we're going to have to release the unit, carry out some refurbishment works, and we're going to have to allow for a rent-free period for the new tenant. But in 2023, we assume a new lease has gone in place and they're paying $60,000 per annum. We're also assuming the rent will carry on in 2024. The first floor and second floor office tenant is paying $100,000, as I said. They're paying another $100,000 in year 2020. We discovered that their rent is up for review in 2022, and we assume that there will actually be a 25% increase in their rent. But we're going to have to allow for costs associated with the rent review. So we'll have to build that into our cash flow. What we get then is our cash flow for the 5 years for $50,000 for year 1, year 2, 125,000. Year 3, there's a lot of work in terms of refurbishment costs, and the ground floor tenant is not in place, so we're only getting 28,000. But then in year 4, our rent has increased to 180,000, and same again in year 5. We will have to build in expenses as well, so we'll have to build in any expenses we may have for managing the property, rent collections, those kind of things that can't be passed on to the tenant. So we've built in, you'll have to assume different expenditures based on different properties. Also, it will depend on what's recoverable from the tenant and what's not recoverable from the tenant. So this is just this very simple, straightforward model. We've applied a 10% discount to the actual rent. As you can see, the rents go up and down, but the level of discount will apply accordingly over the 5 years. So that will impact the actual present day value of that rent that you're likely to receive. It's also important to note that when I'm looking at this, it's a very straightforward, simple example of a 5-year rent review or a 5-year hold. Effectively, what will happen if you're doing this properly is in commercial leases, you're generally going to get your rent in advance or in arrears on the quarter date. So that means you'll get 4 payments a year, not 1 payment a year. So technically speaking, if you're doing this out correctly and trying to work out the exact discounted rate, you should be putting in 4 payments per year in 2020, and same again every other year. So this should be actually 4 columns and you should have quarter one, quarter two, quarter three, quarter four for every single one of your years that you're holding the property. But again, I'm just doing this as a very straightforward example, just to illustrate what's required. Generally speaking, you'll build this up to a far more detailed analysis if you're doing it correctly. But then you'll also have to allow for your exit value. When you look at your exit value, you are looking to sell it in 5 years' time. So this is a valuation in 5 years' time. So it's assumed value in 5 years' time. You know your ground floor tenant is paying 60,000 in 5 years' time. You're also assuming your tenant on the first and second floor is paying 125,000. But you then need to apply yields to those rents. So let's apply a yield of 5.75% to the ground floor tenant. Let's assume there's a break option or something in there that you feel that needs to be accounted for within the yield. The tenant on the first and second floor are a good strong tenant, so you apply a 5.5% yield. You get to a total value of just over 3.3 million. You'll then need to reduce your acquisition costs out of that valuation, because generally speaking, the all risk yield includes your acquisition costs, so you'll have to take that out. So to see what someone would actually pay for the property. When you take out your acquisition costs, which will include stamp duty, currently in Ireland, stamp duty is 7.5% on commercial property, and you'll also allow for legal costs and for acquisition costs for your agent as well. Your net value then in 5 years' time comes out at 2.9 million. However, that's in 5 years' time. That's not right now. So you're going to have to wait 5 years for you to get that. So in order to determine how much that's worth in the present day value, you actually have to discount it for 5 years. And we've assumed a 10% discounted rate. So we discount the 2.9 million for 5 years, we're left with 1.8 million. A big difference there. But then if you get your 1.8 million and you also include your discounted cash flow that you've got in rent every single year for the last 5 years, and you add them together, you actually come out at 2.3 million. So that's what you would pay for the property if you were assuming these details in terms of you're assuming a rental increase, you're assuming a refurbishment cost, and you're assuming your level of risk that you're happy to take on is a discounted rate of 10%. So that's a reasonable price for this property, but let's just check that against the all risk yield. So let's just put that in. We know right now the ground floor tenant is paying 50,000. We know the tenant on the first and second floor is paying 100,000. But we do also know, in terms of applying the yields, that we know the lease is about to expire on the ground floor. So we put a higher yield on it because it's about to expire. But we're fairly confident we'll be able to lease the unit again. So we apply a 6.5% to that 50,000. The tenant on the first and second floor, we know they're paying 100,000, but we also know there's a rent review coming up and they're a good strong tenant, so we apply a yield of 5.2% to that. We're then left with a total value of 2.6 million, and we decide we have to take away our acquisition costs, so we have to take away our stamp duty, legal costs, etc. And we're left with a net value today, if you were buying the property today, assuming these leases are in place, we were left with a net value of 2.4 million. So that's just a very, very quick calculation, and both of them are reasonably similar prices, to be honest with you. What actually you could go into more detail within your all risk yield, and you could say, okay, well, in a few years' time, I'm going to have to refurb the ground floor office, and I'm going to have to allow a certain value within that ground floor office to do. So actually, once you took out your 70,000 or 75,000 in a few years' time, you may apply that to your net value, and you'd actually get two very similar values between your net present value cash flow and also your present value of today using your all risk yield. So therefore, it's a good use for one investor to determine if it's worth their while buying this property. In summary, this is the time value of money. Cash flow is discounted to its present day value. Going back to that spreadsheet, an investor will have to ask, do I spend 2.4 million buying this property that's going to right now give me a rental income of 150,000, or am I better off putting my money in the bank? A seller will have to view, am I better off accepting 1.4 million or keeping on to this cash flow, or do I have an alternative investment to put my money into once I sell this property, or do I want to de-risk from my position? Let me know in the comments below if you have any questions. Please put in a comment if you understand discounted cash flow now. If you're still lost, let me know and I'll try answer some questions in the comments below. I'm also part of a Slack group that have been set up to help property investors. So if you want to join that, I will be popping up some more information on discounted cash flow within that group. So DM me on Instagram or email me and I can add you to that Slack group. If you found that video somewhat interesting, it's unlikely you liked it, but if you found it interesting and have some benefit, please give it a thumbs up. Also, don't forget to subscribe. Next video will be out in a few days on the general market conditions that we're facing right now. Thanks for watching, stay safe and invest wisely.